Well, welcome to the first East Meets West podcast of 2025. My name is Al Velasco. Once again, I'm joined by my friend and colleague from the East, Mr. Gene Lugat. Gino, how you doing today?
Great day to be here. Thanks for inviting me.
You're probably super fired up to be on the podcast even more now that Katie told you that the Gene Lugat interview received the most views in the history of the podcast. I mean, that's probably got to be right up there with some of your greatest athletic achievements at Shepherd University, right?
I'm sure it is. It's probably because I've dialed in and done it, watched the video 100 times myself. So it's probably skewing the data.
I was going to say it was pretty nice for you to send an invite out to your entire family. That was really cool that you posted
everybody's seen it
on Facebook. Well, you and I have been in the mortgage business for a long time, and I was thinking last night, jotting some notes down about today's episode. We've seen a lot of things in this crazy industry. I think you've been in it for 30 plus years. I've been in it for almost 30 years, and we've been here in boom markets and bust markets, and obviously been navigating the last couple of years of difficulty in the industry that everybody's aware of, and certainly many of the folks listening from PrimeLending have all kind of experienced that in different ways. But I can't remember a time that was full of as much uncertainty as we have right now with the election, new administration. We still have all the different challenges relating to inventory and interest rates. And it's just really kind of I feel like we're at a pivot point, in a lot of different ways. And so I think it's really great that you were able to invite some guys at the MBA that are smarter than we are, right? And probably have a little different perspective, on the industry. And they're in Washington. I'm not going to say they're Washington insiders because that would probably be an insult to them. So we don't want to do it at the onset. But certainly, I think they have a valuable perspective on a lot of different issues that we're dealing with. So why don't we jump into it, and Gene, have you introduce our guests, and then we'll get off to the races.
Well, it's an honor to have you guys on the call with us today. I really am excited about having you join us today and talk about some of the impacts of the election, what's happening in the industry, some forecasts about what's going on with some of the regulatory agencies and the changes at the tops of those agencies, and how does that impact our housing industry? Some of the initiatives and the bills we're working on, what are those impacts going to be? And of course, with Dr. Fratantoni on the call, we know that interest rates are critically important to everything we talk about as far as finance and mortgage in the mortgage industry. But we also know that there's a housing shortage out there. And some of these legislative and regulatory impacts we're going to talk about and unpack today will have impacts on that, and maybe how we can loosen that up and what we see happening along the way. So to have that discussion, I'd like to introduce two of the people that I've become great friends with in Washington, D.C., great teammates. I'll start off from your screen with Matt Jones. Matt is the MBA Vice President for Government Housing Finance. He oversees government lending portfolio for MBA's residential policy team. The most important role that I had with him is he manages the Residential Board of Governors. And for me, he was an amazing wingman for me, and did a tremendous job my 2 years as co-chair and chair, helping keep the MBA priorities moving forward, making sure our voice was heard, and was really a great champion for our industry. He hails out of Michigan. He's a Michigan grad. He got his BA at Michigan, his JD at Georgetown University. He lives in Virginia, and he has 2 children, a third on the way. And he is a Michigan fan. He's a Harbaugh fan. So we kind of adopt him into our Harbaugh family here in Baltimore. So we're great to have you. Welcome, Matt.
Thanks for having me, Gene. Excited to be here.
Outstanding. And of course, needing no introduction, we have MBA's Chief Economist and Senior Vice President of Research and Business Development, Dr. Michael Fratantoni. And Michael has been a great teammate of ours, and certainly has become one of the voices that we listen to across the industry. No matter which perspective you had, he brings a great depth of knowledge, background, experience. He has become the recognized industry expert on looking forward. And anytime you look forward, there's chances of accuracy and then near accuracy. And we'll say that he's been a great advocate and a great asset for us at the MBA, and certainly somebody I've come to rely on in many fashions. He has his PhD in economics from Johns Hopkins University. He is a graduate from the from the College of William and Mary. He's part of the tribe from down in Richmond, Virginia. And he's been married for 30 years. He has 2 adult sons, and he enjoys running in his free time and did the Richmond Marathon. I did not know that this year. You did the marathon. How was that?
Live to tell the tale, Gene. Live to tell the tale.
26
still
miles,
alive.
26 miles, no matter which way you count them, right?
That's right.
Well, today, as we said, we're really excited to hear some lively discussion for our audience. And again, our audience is our loan officers, all of our employees, and those who join us today. And I think the thing that's on our mind is really what are the impacts and the unintended consequences or the intended consequences of the changes that we're seeing with this administration. I shared earlier that one of the things we know, as Bill Kelmer likes to say, is elections have consequences, Gene. That's the way it is. So with that said, Matt, tell us a little bit about what we're seeing down there in Washington, the mood, the vibe that's going on, but really what are the impacts that you're seeing immediately? And and we'll jump in as we have opportunity with the group.
Sure. So I guess I'll start by saying I think it's only been 3 weeks since Inauguration Day, and it feels like every day there's been something new and something new affecting our industry directly, right? And so it's hard to even keep up with what the latest is. But certainly, we're still in a place where a lot of the key personnel haven't been brought on board yet, or in some cases they've been nominated by the president but haven't been confirmed by the Senate, right? So we've got just, I guess, 2 days ago, Jonathan McKernan, the FDIC board member, has been nominated to be the director of the Consumer Financial Protection Bureau. That's after, 2 days before that, Russ Vogt, the OMB director, was the acting CFPB director. And 2 days before that, the Treasury Secretary was the acting CFPB director. So keeping up with that alone is required, regular refreshing of your Housing Wire, National Mortgage News. But I know Jonathan well. He's a great, real knowledgeable about our industry in particular. He's a FHFA veteran. He's a Treasury veteran. Used to work for Senator Corker, who was one of the most knowledgeable mortgage minds in the Senate. And then most recently, right, at the FDIC as a board member. Really knowledgeable on our issues, and is going to be a great leader at the CFPB. Again, though, keep in mind it's going to be at least several weeks before he's up for a hearing in the Senate Banking Committee, and then ultimately getting confirmed on the floor of the Senate. Could be a couple of months out because you have to keep in mind there's 1,500 nominees across the entire federal government that have to be appointed by the president and confirmed by the Senate. And the top 21 of those, the cabinet secretaries, the most important ones, all require 30 hours of post-cloture debate. So it really slows things down unless you can get some type of agreement between the Senate majority leader and minority leader to move them faster. Otherwise, we're assuming it's a couple months out before a lot of these individuals are ultimately confirmed. And while they're in this pending nomination, status, they can't really engage with the agency or do much substantively until they actually get confirmed. So McKernan at CFPB, Bill Pulte was nominated to run the Federal Housing Finance Agency. You've got now Scott Turner is the confirmed Secretary of Housing and Urban Development, and then Scott Bessent, the other Scott, the Treasury Secretary. Those are really the key roles that we are paying the most attention to. Haven't heard anything yet on who's going to be our next Ginnie Mae president or our next FHA commissioner. Those are still to come. But again, with each passing day, we're getting more and more information. At the MBA team, we've already made reach outs to the transition and landing team at each of these agencies to initiate those relationships. Many of the individuals we know from prior dealings, some of them are new, but making sure that we're getting in early and often with these new policymakers to make sure we're getting across the top priorities for our industry.
When we think about, what you just rattled off as far as the changes, the number of changes, the sweeping number of changes to be made and the time required to get that executed. And you used a term there, a cooperative environment in the Senate between leadership. Do you see that we have any, as we look out there, obviously Monday we get the notification, the CFPB, the doors are locked and no one's to report to work, to cease and desist as it stands today. How does that impact the morale? What's going on down there, and what are we seeing? We have so many issues that from the MBA, we've worked hard with the CFPB with to get out and instituted. Do you see that this current circumstances right now? How do you see this coming out for the CFPB and for our industry?
So I think hard to tell at this point. Again, everything's changing so quickly, but we do think the dust will settle eventually. Certainly, once you get a Senate confirmed leadership and then the sub director hires again, we think at some point you get back to a more traditional way that the agency is being run, and then we can return to the same kind of blocking and tackling from an advocacy standpoint that we've been doing for a long time, right? Making sure that the CFPB doesn't announce new policy stances via an enforcement action where they're kicking the door in and we didn't know it until the enforcement action, or regulation by blog post, things of that nature. We want things to go through a formal rulemaking process. And then a lot of our favorite issues, right? LO comp. We've been hammering on LO comp, the ability to do bond loans and lower comp for bond loans so the originators can actually make some money doing them. The ability to cut comp for competitive reasons and things of that nature that we've been working with the Bureau for a long time on, and unfortunately haven't made progress. We're going to renew those efforts. But I think in the immediate term, we're just following along like everyone else is as the leadership changes. Clearly, there will be some attrition and personnel turnover as they're going through this hiring freeze and then the specific freeze of the CFPB that was announced on Monday.
So this is actually for both, either of you guys can chime in on this, but you obviously have articulated there's a lot going on, right? A lot of work that has to be done to get everybody in place. We're the average consumers, we're watching all this stuff unfold on TV and seeing all the different press conferences, and the new president obviously enjoys being in front of the camera, so he's providing daily updates. But what's it like from your perspective, just to give some insight, being in Washington, D.C. right now and in and around the government? Is it unlike anything you've seen before? Is it as crazy as it appears, or are we maybe making more of some things than we should as it relates to some of the, I wouldn't say chaos, but all the activity that seems to be happening?
Well, if you watch the news, it looks pretty. If you watch the news, it's looking pretty chaotic. It certainly scares everybody.
I'm happy to kick it off, Matt. I mean, my impression is typically, having lived in DC most of my life, you get the sense that transitions happen, big changes happen, but you're kind of playing between the 40-yard lines of each team. This time it feels like we're on about the 10. It's and for all of our neighbors and and friends who are federal government employees, that is profoundly disconcerting, right? And we don't quite know where things are going to land, but I guess my perspective is it does feel as different as it's being reported through the news. But I don't know if Matt, if you're getting the same impression.
It's definitely different, although, right, this isn't the first Trump administration. So right. We have some experience with although even in my experience, they seem to be moving more quickly than they did in the first 100 days of the first Trump administration, 2017. Just in terms of the DC traffic, it's hard for me to know how long my commute's going to be because we're still trying to gather like how many federal employees are still coming to the office. Are they frozen? There's the return to the office mandate, but then there's a hiring freeze. There's the buyout offer. So certain federal employees might choose to take this buyout. So it's really hard to get a real sense of the trend line yet. But from a regulatory standpoint, a lot of things are still slow because all the kind of rulemakings and FHA, the mortgagee letters we've been following, the Biden administration on their way out the door really dumped a lot of things in the last couple of weeks. And now it's silenced as a lot of those personnel have resigned from the agency. And so from a regulatory standpoint, a lot of things are much slower. But yeah, the things that are driving the headlines on TV, we're obviously paying close attention to those as they're going to affect it as well.
Well, I really love your gauge about what's happening in Washington, D.C. by the commuting traffic. It's the what's in it for me. How's it affecting me? What's my drive time going to be? Well, it's really interesting, as you say, and have already pointed out the fact that we had so much coming at us so quickly there over the last couple of months. We saw some things that we didn't see forecast coming, that's for sure. But one of the things we did foresee coming, and something I know the audience is really interested in hearing, and Matt, this is a question back to you and me as I was told by my teammate that I might die on this hill, and here I am. So trigger leads, 2024. I promised my team I'd have them across the finish line, and just tell me what you think. I off of our ResBug call this week, we had a discussion about this. Can you just share with our audience what you think? And it is a really impactful issue that we have to deal with that I think is consumer impacting. We saw so much support on both sides of the aisle. Just kind of give us an update and take us through there. So if I'm up on that hill, I'm not alone.
Sure. And so this may feel like a Pyrrhic victory to a lot of our members because we were not ultimately successful in the 118th Congress in getting it enacted. But the amount of momentum that we were able to build over the last couple of years through our National Advocacy Conference, setting up hundreds of meetings with members of Congress, and getting, I think, almost the majority of the United States Senate, I think it was 47 or 48 out of 100, co-sponsoring the trigger leads legislation. And then, I don't know, 100 or large number in the House as well. Those are not, useless. They create momentum into the next Congress. At the end of the day, last year, we had certain key members in committee leadership roles that weren't willing to sign off on it for whatever reason. And now we've had a change in leadership at House Financial Services where we think we might have a stronger supporter in French Hill, the new chairman of the committee. He was a co-sponsor of it last Congress. And we think a lot of the members that signed on last Congress are going to sign on again. This issue isn't going away. We understand that our members, the lenders, are getting blamed for all of these calls when they know it's not them that's selling the data, right? And the consumers think it's the lender, and it can become just a headache. It becomes a consumer, CFPB is involved, and it's strange bedfellows, but even the CFPB during the Biden administration was somewhat aligned with us on this issue. And in the Senate, the joke our Vice Chair Owen Lee always makes is, what do Tommy Tuberville and Elizabeth Warren have in common besides a vowel in their last name? Is that they're both sponsors of the trigger lead legislation, right? So the bipartisan thing, it produces such visceral reactions from so many members of Congress. So we think we've got momentum. I think to people that are following along at home, this is another, lesson on how hard it is to get anything through Congress. But we think we've got about as good a shot as any, idea, given the momentum we were able to build through our Mortgage Action Alliance, through all the meetings we've done in the last couple of years. And so while we're not there yet, we think we're in a really good spot for this Congress.
Well, Matt, I can tell you that's great news to hear from our teammates. We, as you know, are a very active MA group, and this is a great opportunity for us in this broadcast to say how important the voices are of each one of you communicating with your state legislative teams and congressmen and senators on these initiatives. It truly does move the needle. It's why we have the numbers we have on this bill and some of the other issues that were out there. And Matt and Mike, as you guys know, we were one of the first companies to have over 1,000 MA members. And we have an active MA group that is run by our regional advocacy champions. And they kind of manage through each region their team and keep them updated, communicated with on key MAA issues. And certainly we will continue to pound away on this particular issue.
That's
Mike,
fantastic.
as we jump forward, Al, what I thought.
I was going to say, Mike's going to tell us where interest rates are going. So I know sometimes he probably feels like a weatherman, right? You get it right sometimes, and sometimes you don't. But obviously, everybody has a keen interest in your perspective on what's happening in the economy, what it might mean for interest rates and housing as a whole. And then I think it would be really interesting to get both your perspectives as to what you think the new administration might be able to do to help with supply, because I think that's probably our biggest challenge in the industry right now, on affordability and other elements. So what's the crystal ball look like to you, Mike?
Thanks. And obviously, a lot of factors go into where rates head. And let me start with the Fed. So Chair Powell was in front of Congress this week giving his latest thoughts. And the phrase that he's used recently is they're in no hurry to cut rates further. And How does he get there? Well, you look at the job market data. In January, the unemployment rate ticked down again to 4%. Job growth isn't fantastic. Companies aren't hiring that rapidly, but they're also not seeing big layoffs. So the job market's doing okay. And then middle of this week, we got the consumer price index number showing core inflation actually ticked up a bit for the month. So we're at 3.3%. If you recall, Fed would like that inflation number to be down closer to 2%. So inflation a little bit hot, job market holding out okay. That is not really a position where they're going to be cutting rates anytime soon. Our forecast is they'll probably do one more cut this cycle, maybe middle of this year, a little bit later. They are continuing to shrink their balance sheet, but at a slower pace, and that may stop. So from a monetary policy perspective, we may be kind of stuck for a bit with short rates at about 4%. Then you go to the long end of the curve, which is much more impactful for mortgages. And we've seen a 10-year treasury. It was as low as 3.6 in September. It was as high as 4.8 in January. We're at about 4.5% today. You think about what happened at the election. I think, going into the election, the sort of betting odds were kind of a coin flip for the presidency, but an expectation that either way we'd come out with divided government. As we've talked about, that is not the case. We got Republican control of House, Senate, and the White House. And markets reacted immediately saying that means they're going to move faster. They're going to be able to, with all the challenges they still have, they're going to be able to move faster than if there was divided government. We immediately saw rates jump up. And sort of we interpreted that as an expectation of somewhat faster growth with a lighter touch regulatory environment and probably more favorable tax policy, a little bit higher inflation as a result of that faster growth, larger deficits, and with that, some pressure on the long end of the curve. So the third piece of this puzzle, though, is you got to look outside of the U.S. And outside of the U.S., not a lot of growth, right? The U.S. is by far the strongest economy in the world right now, and that's going to be weighing down on growth. So our expectation is that we're going to be sort of stuck in this tug of war. There are going to be times when those inflation and deficit headlines are driving rates. There are going to be times when weak growth around the world is going to be driving rates. So we think on average over the next couple of years, 6.5 mortgage rate is where we're going to be. There are going to be times when we're closer to 6, then we're times when we're going to be at or above 7. We're at about 6.8 today, right? So I think in some ways that's going to be favorable for the environment because I think your home buyers are now accustomed to a 6 handle on a rate, right? And they're no longer looking for a 3 or a 4. So I think that's where we are. Let me stop there, see if you got thoughts or questions.
Yeah. It's great insights. The one thing I know Al maybe would jump on this as well is the spread between the 10-year Treasury. These spreads have really been in our careers largest that we've ever seen between our 30-year fixed rate and where the 10-year Treasury is. Talk a little bit about where we see some shrinking in that right now. We've seen that come back a little narrowing, but we're still at historically high spreads.
That's right. Yeah. I mean, for much of 2023, we were at 300 basis point spread. We're at about 225 right now. Our forecast has that coming in to about 200 by the end of the year. Historically, the average is about 170. So getting a little better, but I think because of concerns about the Fed selling off their MBS at some point, it's going to stay a little wider than normal. But I think that's a positive, and that's what gets us to our 6.5 mortgage rate forecast. But again, think about that 6.5 as the average, but really 6 to 7 is going to be the range we're playing in.
Well, the Fed appears to have been, obviously really focused on jobs, right? And I think in some of the testimony that Paul has done, he's talked about wanting to keep an eye on really what's happening in employment. And when you look at the employment reports, and I think this was true even in the last report, there were a fair amount of government jobs, and that's been pretty consistent. So you have all the stuff going on as it relates to, I think Matt touched on it a little bit, about the uncertainty around federal workers and what will happen with that number. You also have part-time jobs pretty dominant in the surveys. And then you have service sector jobs. And what doesn't seem to happen is that you don't have a lot of full-time jobs being created. And so I'm just curious from your perspective, when you look at inflation, Are there certain jobs that create more inflation than others? And if that's the case, how could the makeup of the jobs that are being currently created by the economy, really impact inflation going forward? Does that make sense?
Yeah, no, good question. So I totally agree. The job picture is much cloudier than it typically is, right? On the one hand, the hiring rate is the slowest it's been in 15 years, right? There were fewer job openings than there were 12 million job openings at one point. Now there's about 7 million. So for folks that are looking for work, it doesn't feel like a strong job market. But for folks that are in positions, wage growth is pretty solid. And again, there's not this concern of mass layoffs sort of outside of the federal government sector. I think I'm going to agree with you that there certainly are some parts of the job market, if they heat up, particularly in sort of that retail service sector, where the pass through into prices that consumers pay is very, very direct, and we're not seeing that kind of wage price pressure or wage price spiral that you worry about. So I do expect that inflation number is going to come down to the Fed's 2% target, but it's still going to take another 12 or 18 months. And it probably will be in the presence of a job market that continues to weaken sort of bit by bit, month by month.
As we talk about certainly the interest rates, we talk about the legislative changes at the top. Matt, one of the things that we all know, and Dr. Fratantoni, you've spoken into the fact we don't have an interest rate problem. We have a supply issue. The industry, every one of my teammates that's listening to this call right now, all of these things are critically important to where we get to. But right now, we don't have enough properties to sell. We have too many out there on a to be determined basis. We're processing a lot of wannabes. Matt, we had a conversation in Redbug that's kind of interesting to see what's manifesting with Pulte coming into his role from the building background. Certainly that's positive, at least from a visual standpoint. But talk about some of the bills we're seeing pop up across the country right now on investor loans or on investors, what we see really coming up as far as trying to stop investors from buying houses in markets to help fight this. What is your thoughts, and where are the MBA kind of landing on that, or where are we headed?
Yeah, good question. So certainly there's been a lot of attention around non-owner occupants buying up often in cash, a lot of single family rentals, sometimes entire neighborhoods, right, that are being built to rent. And in response to that, I believe it's 7 state legislatures have now introduced legislation attempting to create some type of restrictions around the ability of non-owner occupants to purchase. They're all kind of different flavors. Some of them get around it by taxing the non-owner occupant that purchases the property. Some of them are structured like giving a right of first refusal to a first-time home buyer or an owner-occupant offer, and it basically ices out a non-owner occupant for 30 days. Some of them just create a cap on if you are over X number of units that you own as a corporate entity, you can no longer own them in that state. Now, some of those things raise constitutional issues, and then that's what we're looking at, regulation of interstate commerce, et cetera. But, we understand the attention around this, given the challenges that first-time homebuyers have to access home ownership, which we all know is such an important, valuable ladder to financial security. So, what we're doing at the moment is getting a real scan of what's out there, understanding the way that these state legislatures are going about it, making sure that we're not creating, second and third order effects that are not intended. For example, if you're a servicer and you have REO properties through foreclosure, does that trigger, a problem with one of these bills? We want to make sure that things like that are carved out. But I think the overarching intent here, we understand. I think it's nationwide. We were talking about this yesterday. Something like 2 to 3% of purchase offers are coming, or maybe actual purchases are going to these types of institutional buyers, and that's particularly pronounced in certain markets, right? More so than other markets. But understand, when we're talking about affordable housing and housing supply, that's a big component of it. Certainly, and we can also get into, other efforts that we're doing to try to stimulate the production of housing. It's really a supply side question. But yeah, that's what we've been tracking with that issue.
And Gene, maybe just a few thoughts here. I mean, I think you've seen our forecast looking for purchase origination growth this year, and that's coming from a couple of different factors. One, we're expecting about 5% growth in existing home sales, 10% growth in new home sales. And really, that is being fueled by the improvement in the inventory numbers that we're seeing. So from a longer term historical perspective, it's still tight, but really, thankfully, it's headed in the right direction and at the right time of year. So I'm thinking, if we have stable mortgage rates and there are more properties available, we really do have an opportunity for a much better spring home buying season than we've had in some time. It's not going to be a gangbusters year, but it's better than the last couple of years, and that really is a reflection of the improving inventory environment. And you are seeing home values increase more slowly in most parts of the country. You're seeing some declines along the Gulf Coast. And I think all of that, again, reflecting that improved inventory environment.
So I know that we're running close on time here, but so Mike, I'm curious, is there anything that you're thinking about that might come at us, maybe a black swan of some sort that could upset your forecast? Is there any one or two things that you're concerned about that we might see happen?
Well, remember just a couple of weeks ago, the headline we all woke up to about DeepSeek, right? And this new AI competitor in China, and NVIDIA, one of our strongest companies, lost $600 billion in market cap in a single day. That was the biggest loss we've ever seen. And this is at a time when the stock market valuations, to use Alan Greenspan's term, are perhaps irrationally exuberant. And so I worry a bit about a stock market correction, coming at a really inopportune time, because obviously for portions of the home buying market, that really does impact buyer confidence and sort of buyer willingness to act. So that's one thing I've sort of got my eyes on, is just sort of that financial market disruption, that one piece of news could have such a huge impact.
Well, let's hope we can avoid that. That's all we need, right? Introducing another element.
Exactly.
Well, if I could just throw one more thing out there that certainly is impacting our buyers out there today, and I know we're late on time. Matt, I know just for our audience, we're going to probably see more and hear more questions about this, and it's not a federal issue, but the insurance issues and the impacts of the insurance with the storms, the impacts are going across, affecting much of our geography here in this country, and certainly a lot of the people on this call today. It's a primary factor for our condo deals as HOA impacts, but really what's happening with the insurance industry today.
Yeah, and this is a topic that comes up at virtually every conference we do. Every week we're talking about this issue because we see premiums increasing across the country, especially as you would expect in the markets that are the most vulnerable to natural disaster type events. And we got to keep a close eye on particularly like retirees or individuals on fixed incomes that have been performing on their mortgage for years, and maybe they see their insurance bill year over year double or triple. What are the spillover effects that can create for the entire market? It's something we should be really keeping an eye on. I think in terms of how you resolve it, there's not a lot of easy questions, right? And that's what we struggle with is, what can we do more than just appreciate the problem, right? Insurance is regulated at the state level. Congress has really limited carrots and sticks to get at this problem. They could create a giant reinsurance structure, although the political will to do that, in my opinion, would play out the way that flood insurance does, where you have regional disagreements and you have certain senators and members of the House that care a lot about it and others that don't. So I don't know that the will is there to do much. I think the most likely scenario is you see that the states that are the most impacted ultimately will have to find some way to subsidize it, and we're already seeing that with the fair plans, right, are becoming in Florida and California, in a couple of the states, the most subscribed to, or I guess the most utilized carrier in the state. And so it's a really concerning trend long term. Still struggling to, there's no silver bullet on this. I don't know, Mike, do you have any other thoughts on that?
Just as you said, that it comes up in every single conversation. I don't think there's any easy answer here. Different answers in each part of the country. But I would expect it's going to continue to get attention at the federal level, but not sure what else they can do besides shine a light on it.
Yeah, that's a tough one. I wish we had better answers.
Well, certainly there's not the easy answers to any of the questions or any of the challenges we have out there in front of us, but we know one thing. We have champions at the MBA working on our behalf. Our voices are being heard by our MA associates across the country, and we're just really proud to be part of the MBA. My career with the MBA has been amazing, and I certainly appreciate the two of you guys being great wingmen for me when I was chairman of RESBOG, so thank you.
Thanks for having us, Gene.
You guys have a lot of work, and we obviously wish you well. Your success is our success, so we really appreciate you guys coming on board, sharing your insights with us. I know there's a lot of things we could have got to, so maybe we can have you back in the middle of the year, and we can see how much progress you all have made. So thanks for investing time in our team.
Picking the body up off the hill, that's what you're thinking.
That's right. No. Let's think more positively than that. Well, thanks, you guys, and thanks for everyone listening. And just a reminder to subscribe to the podcast on whatever platform is your favorite. And we'll be back with you again in a few weeks with another episode. So thank you and have a great day.